Matt, I know that you guys are, and have been for a long time, quite active in the residential space, both land, townhouse and apartments. If we just zoom in on that specifically, where in terms of product and scale and location are you feeling that there is the greatest sense of resilience and also the greatest risk?
What I'm noticing at the moment is there's such a strong and immediate correlation between consumer and business confidence and the confidence of people to keep their job and commitment levels. The ability to market and to get people to an open inspection right now is really tough because their confidence level in declining asset values means that there's not really a fear of loss in people staying out of the market when in fact buyers are continuing to build up in the market. In any market, there's a natural absorption rate that's relatively stable over a long-term historical level. So buyers are still needing to transact. They're still needing to buy properties for all sorts of reasons, all these life events that go well beyond just the investment market. So those life events don't stop, but confidence stops and the urgency to enter into a market stops. But at some point, that natural absorption rate is slowly building up in the background in a number of markets at the moment. When COVID came on, the same thing happened. Sales fell over everywhere. The moment that COVID started to improve and the media and the publicity and the promotion around the positive news story without the panic, those buyers came back into the market. They never left and they didn't magically just appear. They were always there. They just weren't engaging. And that's the problem that the market has right now. The developers need to hold their portfolios and they need to hold their land banks and hold their nerve at the moment, as well as financiers, because the market conditions will come back. The government will continue to stimulate the market. They'll look for the holes in the market in terms of economic risk, and the federal government will continue to fill those holes as and when that they need to the point where eventually we'll cycle out of this phase and we'll return to normal market conditions. Every market is different. And right now, the first home buyer market in apartments is quite difficult. And it's because of the valuation risk. First home buyers are on a knife edge typically with the amount of deposit that they need. And the challenge at the moment is at the moment that the valuation comes in 5% or more, it's extremely difficult to convert upon that sales. Right at the moment, because of confidence, you've got minimum number of people showing up at inspections, but you've also got the problems of converting them down the sales funnel all the way to a completed sale. So pre-sale risk right now would be quite high. The financiers acting for the banks are obviously being a little bit conservative at the moment. Traditional high density markets in Sydney, Melbourne and Brisbane would probably be the most at risk there. The land submarkets is completely different. There's a stimulus at the moment that's due to run out with Home Builder and the First Home Buyer Grant and various other stamp duty incentives that the state governments are providing, which is really stimulating that market. And it has to, because the construction industry is going to be absolutely on its knees if that stimulus wasn't available currently, and it's probably likely to be extended in some form into the early part of next year. So the land submarket is quite strong at the moment. The other thing to consider is that on the supply side, the building approvals are off dramatically on a national level. There's a disconnect there. So I think a shortage of listings generally right across the market nationally is underpinning property values significantly beyond what probably most forecasters thought. And that's true in the established market. And I think it's probably going to be true in a number of the markets over the next 12 to 18 months, because new supply is going to be limited. And whilst I've never been a huge fan of regional development and investment because of the volatility and the depth, the problems with depth of market there, we're seeing population growth, especially net migration into Queensland, being at an absolutely record high. And it's driven by two things, mainly lifestyle, but also affordability. So I think regional locations, they're the only markets which are seeing positive price growth. And it's because people that are employed are relocating with employment that just aren't working from the city offices.
And I'm sure, Matt, it's got nothing to do with the blue skies that are sitting behind you at the moment.